Putting your money into a high-yield savings account is one of the simplest ways to earn extra income with minimal effort. I've been using them for years and they've been a reliable source of passive income. That being said, before opening a high-yield savings account, there are some important things that you need to understand so that you can maximize the benefits. The most important thing that you need to understand is taxes. With a high-yield savings account, the interest you earn is considered taxable income by the Internal Revenue Service or IRS. That means you'll owe taxes on it. Here's how it works. If you earn $10 or more in interest in a year, your bank will send you a 1099 INT form. You're required to report that interest when you file your tax return. Many people don't realize this because they keep their money in a traditional savings accounts at big banks like Wells Fargo, Bank of America, Chase, which typically offer extremely low interest rates around 0.0% to 0.3%. At those rates, most people don't even earn $10 in interest per year. For example, you would need about $100,000 in a low interest account just to earn $10 annually. That's why most people with regular savings accounts never end up paying taxes on interest because they simply aren't earning enough for it to matter. Now, the amount of tax you pay depends on your income tax bracket. Currently, the federal income tax rates range from 10% to 37%. For example, if you're single and earn up to $11,925 per year, you fall into the 10% tax bracket. Now, let's say you have $10,000 in a high-yield savings account earning 3.1%. Over the course of a year, that would generate $310 in interest. That $310 is added to your total income and taxed at your 10% rate, meaning you'd owe about $31 in taxes and keep a roughly $279 in your pocket. As you can see, earning interest from a high-yield savings account is still worth it. Just be sure to set aside a portion for taxes or consult a tax professional to explore ways to minimize what you owe based on your situation. Most importantly, don't let taxes discourage you because in the end, you're still making some profits. Another thing many people overlook is that interest rates on high-yield savings accounts can change at any time. These rates are typically influenced by broader economic and market conditions. So even if you start with a strong rate, it may fluctuate over time and any time. That said, high-yield savings accounts still consistently earn much more interest than regular savings accounts, making them a smart place to keep your money. Another thing you need to remember is that not all high-yield savings accounts are as safe as they seem. For your money to be protected, the account needs to be insured either by Federal Deposit Insurance Corporation for banks or the National Credit Union Administration for credit unions. This coverage protects up to $250,000 per person per institution if the bank or credit union fails. If you're holding more than that at one bank, consider spreading your money across multiple institutions or choosing accounts that offer additional coverage. Be especially careful with fintech companies. Some don't have direct FDIC insurance but instead partner with insured banks to provide you the protection. That can still be safe, but only if it's clearly stated. Always look for phrases like member FDIC or NCUA insured and verify the institution on official FDIC or NCUA websites. If there's no mention of insurance, your money may not be protected and it's best to avoid them. So stick with your reputable insured banks or credit unions and your savings will be secure. And the thing to keep in mind is that high-yield savings accounts may come with certain requirements to qualify for the interest rates. And they can also have limits on how those rates apply. For example, Axis Bank requires at least $1,500 in total monthly qualifying direct deposits and an average daily balance of at least $1,500 in order to earn their 4.21% interest rate. And if you cannot meet those requirements, you will only earn a base rate of up to 1%, which is basically nothing. Then Andrews Federal Credit Union gives 5% interest, but up to $1,000 only. And SOFI Bank offers up to 4% interest rate when you set up eligible direct deposits or make qualifying deposits of $5,000 every 31 days. On top of that, you can earn up to $400 sign-up bonus by meeting their direct deposit requirements within 60 days. If you sign up using my link in the description, you'll get an extra $25, bringing your total bonus to $425. Just make sure to review all the requirements carefully so you can maximize the benefits of your savings account. Another important thing to know is that you can access your money in a high-yield savings account whenever you need it. Unlike some interest-bearing accounts that require you to lock your funds away for a fixed period, high-yield savings accounts give you the flexibility to withdraw your money at any time. That said, some banks do place limits on the number of withdrawals or transfers you can make each month. So if you tend to move money in and out of your account frequently, be sure to choose a high-yield savings account with limits that work for your habits or no limits at all. When it comes to withdrawals, most high-yield savings accounts don't include an ATM card or direct ATM access since they're designed for savings rather than everyday spending. To get cash, you typically need to transfer funds to a checking account first and then use that account's debit card to withdraw the cash. If you regularly withdraw cash from savings, it's a good idea to open a high-yield savings account alongside a checking account. For instance, SOFi offers both account types with a debit card for easy access, while Lending Club can provide an ATM card for its high-yield savings accounts upon your request. One more key thing to understand is that most high-yield savings accounts come from online banks. They're able to offer higher interest rates, low or no fees, and even sign-up bonuses because they don't have the overhead cost of physical branches. That cost savings gets passed on to customers through better rates. In most cases, banking online isn't an issue since so much of our financial activity already happens online today. Many of these banks also prioritize customer support, often providing help through chat, email, or phone, sometimes even 24/7. Plus, they typically offer mobile apps that make it easy to manage your account, transfer funds, and handle deposits or withdrawals whenever you want. Just make sure to choose an online bank that's FDIC insured and has a solid reputation for good customer service. Another important thing to keep in mind is that you can open multiple high-yield savings accounts. Many people assume they're limited to just one, but there's actually no cap. You can have several accounts either with the same bank or with different ones. For instance, I personally have two, one with Capital One Bank that offers both physical branches and online access, and another one is SOFi that offers entirely online. Both currently offer competitive interest rates in the range of about 3% to 4%. It's also important to note that not all high-yield savings accounts are the same. While most offer competitive interest rates, some stand out by providing added perks like sign-up bonuses, built-in savings tools, and even early access to your paycheck up to 2 days in advance. While high-yield savings accounts are useful, they aren't ideal for long-term investing or building wealth. They work best for short-term goals like an emergency fund or money you will need within a few years because they keep your cash safe and accessible. However, they are not designed for significant growth over time. One reason is that their interest rates often don't keep pace with inflation, which means your money can gradually lose purchasing power. For instance, if your account earns 3.1% interest but inflation is 3.3%, your balance may grow but its real value is actually declining. On top of that, the returns from high-yield savings accounts are typically lower than what you might earn from investments like stocks or real estate. For example, if you deposit $10,000 into a high-yield savings account earning 3.1% interest, you would make about $310 in a year. But with inflation at 3.3%, the purchasing power of the $10,000 would actually drop by around $20 over the same period. On the other hand, if you invested that money in the S&P 500, which has historically returned about 6.5% annually after inflation, you could earn roughly $650 in real gains. That said, investments like these do carry some risk. If you prefer to play it safe, a high-yield savings account may be the better choice. Either way, you need a place to keep your money, so you might as well earn something on it. So those are some of the key things you should understand about high-yield savings accounts to get the most benefit from them. But none of that will really help if you don't know how to choose the right account or fully understand its advantages and drawbacks. So make sure to check out my other video where I break down different savings accounts and go over their pros and cons. I hope this video is helpful. Please don't forget to share and subscribe, and I'll see you in my next video. Thank you.